put this all in context with Frances Donald, who watches all of this very closely. She's Global Chief Economist at Manulife Investment Management, and she joins us now. Before we get into specific country plans, Frances, you sort of have this united market view today on less hawkish policy from central bankers. What is your broader view right now?
Rate cuts are coming,
okay,
and they're coming pretty soon, John. But the question is not so much are rate cuts coming? We know they are. Every major central bank has at least indicated it, or they've paused and said it's the end of the tightening cycle. We know that's on the docket. The more important question is, why will they be cutting rates? The bull case, the reason that markets are feeling pretty joyous right now, is that it's because inflation is coming down. They don't need to be as restrictive, but growth is still going to be strong. That is the soft landing narrative. And yes, it is very bullish for all types of risk assets and also for bonds. More problematically will be if the rate cuts come because the economy deteriorates. That is the risk case. It's the one that I worry about, John, because we have seen some weakness in the labor market. We have seen, especially in Canada, consumer cracks. When economies weaken, they don't tend to weaken in straight soft lines. They tend to accelerate in nonlinear fashions. Those things tend to get worse fast. So the big question that keeps economists up at night is rate cuts coming? Yeah, probably June for the Bank of Canada and the Fed. It's going to be how fast are they cutting and why are they cutting? That's going to be what determines market reaction.
And I tell you, when I sit here all day, you hear some people with the bullish view, some with the bearish view. So you go from smiles to feeling a little jittery. You can feel all over the place. I guess my question in response to that is, how will we know? Like, what will be the indications that in a case of deterioration for the economy that it's playing out like that?
And it's so funny you mentioned that, because I often say this to my team too. Two things can be true at the same time. We can believe that there is recession risk and problems ahead, but not believe that we should trade it now. And that's probably why we get a lot of this, juxtaposition of those who call for downside risks, but also those who still feel like it's right to be long the market. And I think that's true too. So when will we know when it's time to get worried? Well, we got to watch jobs. Jobs is the absolutely most important thing. And we have seen, especially in the United States, but also in Canada, some weakness occurring there. Now, critically, we also need to watch what are the central banks looking at. And I was hoping for a lot more from the Federal Reserve yesterday. There's another reason why you have both a lot of bulls and a lot of bears, and that's because the data is zigzagging. In the United States, we have some inflation measures that say inflation is still really sticky, like up near 3 to 4%. And you can manipulate other inflation data to say it's below 2%. Canada's a little bit of a cleaner story. We know inflation has really come back down towards the 2% level, but you can pick and choose whatever data you want to tell whatever type of story. So my issue is that once you start seeing weakness, typically, historically, that weakness spreads. It doesn't go in the opposite direction, but the core is going to be jobs and how consumers fare with these high interest rates and a lot more renewals, especially in that housing market, John. Those are coming through at a much higher rate now than they have in the past couple of years.
So everything you're saying adds so much layer to what we simplify, which is what is the market pricing in on things like rate cuts. Let's just go through Canada and the U.S. We'll start with the U.S. because we just had the Fed decision. You referenced analyzing what Jay Powell had to say yesterday. I think generally speaking, there's a view that 25 basis point cuts, that's something that you might want to bet on this year, just sort of looking at what the Bloomberg data is telling us right now, some of what Jay Powell was talking about yesterday. What is your own expectation for what the Fed does from here on out?
Yeah, we have 3 rate cuts as a base case starting in June. But just a reminder, both economists in the biggest shops, the little ones, and the market, they have these kind of base case expectations, but that doesn't really give you indication to just how wide the set of possibilities are. So in our base case, we have a small recession in Canada, inflation comes down, a small recession in the United States, inflation comes down, and central banks can gently ease about 3 times this year, 5 times next year. But I got to tell you, John, that's a very narrow tightrope to walk, because our expectation is that there's a big risk that things actually unfold and the economy deteriorates more quickly, and you would see later cuts and faster cuts than what we're currently looking at. So again, those market expectations, they don't actually show you the breadth of possibilities that come through. They're sort of like the baseline average of outcomes. I hope that we only have a small recession, that we get central banks that can move softly down. But historically, that's not what happens, John. Historically, you hit a recession and rates have to come down a lot faster. For some people, for example, those with mortgages, that's good news, but it also suggests that maybe the employment side of the picture might be a little bit more difficult.
Well, as you said, watch the jobs market. Now, just to go a little deeper into the Canada story, a reminder to our audience that the Bank of Canada has been pretty cautious about saying whether there will be rate cuts, but the market has to price in everything that's happening, including the latest inflation numbers. When it comes to your own expectations for the Bank of Canada, just to add a little bit more to what you were just saying, what do you think happens? Take us through the range of possibilities.
I was having a big conversation with my team this morning and our colleague Dominic Lapointe, and we were saying, if this inflation data that we've seen, so traditional measures of core inflation in Canada are at 2.1%. If we got that a month ago, we could probably see rate cuts at the next meeting, but there's just not enough data to give the Bank of Canada full confidence to go probably until June. So that's our base case expectation. And remember, most global central banks are going to start in June. The Fed, the ECB, the Bank of Canada will be in very good company. And of course, we have the Swiss National Bank that has already moved. The Bank of England today indicating they're moving towards rate cuts, maybe June, maybe August. We'll have to see. At the end of the day, John, we're talking about individual meetings that in the grand scheme of things just don't matter as much as this really critical pivotal moment. We are no longer in rate hikes. Rates will be moving down. This is an easing cycle. We've only had 5 of those in my lifetime. I don't want to give away my age here, John, but these are rare events, rare pivots. We are now at this inflection point where rates are going to be moving lower. Whether it's May or June or September will matter way less to most investors and to fewer Canadians than it might seem on the surface. The core is, are we having more higher rates? No, we're having lower rates. And how much are they going to fall? At least 3 times this year, potentially more.